Nobody took your money. No one hacked your account. No one changed the number in your banking app. Your savings are sitting exactly where you left them. Same balance, same account, same bank. And yet, quietly, without your permission, without a single notification, you are getting poorer. Not because you spent anything. Because you saved. This is the part of money that almost no one explains clearly, and the part that the financial system would very much prefer you didn't think about too hard. There is a fee built into every currency on Earth. It doesn't appear on any statement. It wasn't disclosed when you opened your account. And it applies to every dollar, euro, rupee, or pound you've ever set aside for the future. That fee is called inflation. And the way it actually works, not the textbook definition, but the real mechanics beneath it, is considerably more uncomfortable than most people realize. Let's make this concrete. In January 2020, the average price of a dozen eggs in the United States was about $1.50. By early 2023, that same dozen eggs cost closer to $4.80. That's a price increase of over 200% in roughly 3 years. Eggs. A product that hasn't changed. A product that has been produced the same way for a century. The egg didn't become more valuable. The dollar became less powerful. And here's the part that stings. If you had saved $100 in January 2020 and done nothing with it, just kept it in a basic savings account earning the national average interest rate of around 0.06%, you would have watched that $100 quietly lose somewhere between 15 and 20% of its real purchasing power by 2023. You didn't spend it. You didn't invest it. You did the responsible thing. And you still lost. To understand why this happens, you have to understand something about how money is actually created, because most people have a fundamentally wrong picture of it. The common assumption is that governments print money, distribute it, and the amount in circulation is more or less fixed. Controlled. Managed carefully by serious people in serious buildings. The reality is stranger than that. The vast majority of money in a modern economy isn't printed by governments. It's created by banks, commercial banks, the kind you have a checking account with, every time they issue a loan. When a bank lends you $50,000 for a car, it doesn't go into a vault and retrieve $50,000 in physical currency. It types a number into a system. That number didn't exist before. Now it does. And now there is $50,000 more in the economy than there were 10 minutes ago. This process is legal. It is the foundation of how modern banking works. And it means that the money supply expands constantly, not because governments are reckless, though they sometimes are, but because lending is happening every second of every day, all over the world, creating new dollars from nothing. More dollars chasing roughly the same amount of goods and services. Which means each dollar, gradually, buys a little less. That is the invisible fee. And you are paying it whether you understand it or not. Now here's where the irony becomes almost darkly funny. The people who are most exposed to this fee are the ones who were told, their entire lives, that they were doing everything right. Save your money. Build an emergency fund. Don't take unnecessary risks. Keep 6 months of expenses in a liquid account. All sound advice. All of it quietly taxed by inflation in a way that no financial advisor is required to disclose up front. Meanwhile, the people and institutions that borrow large amounts of money, at fixed interest rates, often benefit from inflation. If you borrow $1 million today at 4% and inflation runs at 6%, you are, in real terms, paying back less than you borrowed. The debt shrinks in real value. The savings erode. The system, by its basic mechanics, transfers wealth from savers to borrowers. Slowly. Invisibly. Continuously. The central bank's official target for inflation in most developed economies is 2% per year. This sounds modest. Almost reasonable. But 2% annually means that in 35 years, the purchasing power of a dollar is cut in half. The money you save at 30 is worth half as much in real terms by the time you're 65. Not because of a crisis. Not because of a crash. Because the system is functioning exactly as designed. The 2% target isn't an accident or a compromise. It was chosen deliberately, because a small, consistent level of inflation encourages spending and investment over hoarding. It keeps the economic engine running. It makes debt more manageable over time. All of which might be reasonable policy, unless you're the one sitting on the savings. And this is the broader implication that most financial content quietly skips over. The entire architecture of modern money is built around the assumption that currency is a medium of exchange, not a store of value. You're not supposed to hold it. You're supposed to move it, spend it, invest it, deploy it into something that keeps pace with or outpaces inflation. Which means that the advice to just save money isn't neutral. It's a slow loss, dressed up as responsibility. The difficult truth is that in a system designed this way, doing nothing is not a safe option. It just feels like one. So the next time you look at your savings account balance, the same number it was last month, maybe a little higher, ask yourself one question. Higher than what, exactly?